first room 2026. Let's dive in. We have important data coming out tomorrow. Let's discuss it. Tell us what's coming. Tell us why it matters, and we can go from there.
So I covered this in the market pulse today as well. So tomorrow it's just labour market data. Essentially, this inflation data and labour market data is always the two most important pieces of data at this moment in time, and to be honest, it has been for like a long time. Because essentially those are the Fed's two dual mandates, and they work. They can at times work in tension with each other. For instance, if you have higher inflation and a weakening labour market, the Fed is then in a tricky spot as to whether they can lower rates or increase rates. At the moment, it seems that inflation it's sticky at 3. Like, just roughly speaking, this is like headline stuff, not in the details in the weed stuff. It's sort of sticky around the 3% mark, high twos. Oh no, it came in lower at 2.6, 2.7 last month. But essentially it's been stickier towards that sort of high twos, low 3%. That has then kept the Fed at like a higher rate, even though they've been lowering the interest rates. It's kept them at a higher rate for slightly longer than what, say, Trump would like, etc., etc. But should the labour market start to fall off a cliff, or deteriorate in a more meaningful way, i.e., big job losses, a spike in the unemployment rate, which we've not really seen. We've seen the unemployment rate climbing like slightly, very slightly, but in a gradual sense, rather than again that falling off a cliff sense. So the Fed are lowering rates to sort of temper to that a little bit, but at the same time, they don't want to go too gun-ho and lower rates down to sort of what they would call below neutral, which might be sort of 3%, something like that, which is maybe where neutral is. So below 2.75%, 2.5%, etc. So at this moment in time, labour market is sort of, even though it looks weak, it's sort of holding up, but inflation is sort of sticky. The data that's coming out tomorrow, the forecasts are for 45k jobs added and unemployment to 4.6%, so unchanged. So this doesn't really change much for the market, for the Fed, and therefore for markets, should it come in at those numbers, because it essentially is saying the same thing. Inflation is still sort of sticky towards high twos, and the labour market is holding up, but at the same time, it's not falling off a cliff. So the Fed sort of indicated in their December meeting that they're looking to stay on pause for a period of time. What that period of time ends up being, we don't know, but we know most likely it's at least a skip. So a skip of the next meeting, which is no rate cut at the next meeting, which would be late January. The following meeting would be mid-March. So it's possible. So at the moment, the odds of a January cut are very low, but they do jump up in mid-March to about 39%. So the market is sort of looking at a skip now, maybe a cut in March, close to a 50-50, but it's not. It's like 40-60 chance. So really tomorrow's data, it's usually very important. The inflation data and labour market data are usually very important because of these dual tensions moving and what it then means for rates. At this moment in time, the Fed have sort of forward guided their path. So you'd have to see a meaningful change in that, a meaningful change outside of the forecasts in tomorrow's data for there to be a meaningful change for the outcome of January's meeting. So our expectation is the numbers will come in around where they're forecasted to come in. Employment will stay about 4.6, 4.7. It might tick up very slightly, but as long as there's positive job growth, as long as there's jobs added, the Fed can pause in January and slow down the pace of rate cuts. Still do rate cuts this year, but not do rate cuts at every consecutive meeting. So unless the labour market shows signs of falling off a cliff tomorrow, even then that might bring rate cuts back to the table, but it won't necessarily be a good thing if you see the labour market falling off a cliff. But again, you need to see this at month-on-month data rather than if we was to see this just as one print, that won't really change the Fed's actions that much. They'd want to see multiple months of that data of labour market falling off a cliff to drive the rate actually lower. So tomorrow, I don't think it will actually change much. I don't think markets will be volatile around the print, but that's probably about it.
Yeah, that makes sense. So if the jobs data comes in as forecasted, the market it's probably not going to react. because it's already kind of priced this in. If numbers come in a little softer, the market might react negatively, maybe a bit of a pullback, but nothing significant. Would you say that's correct?
Probably the opposite. I think then they would maybe not price in a January cut, but they would the odds of a cut in March would probably increase from 39% to say 50%. And it depends how much it weakens by. If it shows job growth of like 5K, 10K, 15K, and unemployment ticks up to 4.6, 4.7, won't change
Yeah.
much for January, but it might change the odds for March, and the market might like that and think, hang on a minute, we're now on for maybe 2 or 3 cuts this year. Or for like, it's expected, the market's expecting 2 cuts, so the market might now say, oh, maybe we can get 3 cuts this year. But it's not weak, and the labour market wouldn't be weak enough that it's falling off a cliff necessarily. So I think a slightly weaker print would be the sort of most beneficial outcome for risk assets, crypto, Nasdaq, etc.
Yeah. Yeah. And if we see it on the downside, if it comes in worse, so the numbers are better, then maybe a small pullback, but nothing significant.
Yeah, I don't think it'd be very significant at all. I think it'll be very small, and I think it's one of those ones where the day trading guys will get whipped up in the following hours, couple of hours. But I don't think it'll be actually much beyond that, and it'll be it's easily one of those ones where you could see a whipsaw in the first hour, and then price sort of return to where it was. So I'm not really. I don't think this tomorrow's data is as meaningful as prior labour market data points. That's for sure.
That makes sense. Absolutely. And we're looking at 2 rate cuts for 2025 at the moment being priced in, 2026, I should say. How many do you think we end up getting?
Or
4. Okay. What are the
I
polymarket
think
odds
people
on
are
that?
underestimating. I think people are underestimating the impact Trump can have. Um, I think the main problem will be how, again, this is sort of going into the weeds a little bit, but and remember, I called for 3 rate cuts last year, saying that they were going to pause and then go and cut right towards the back end of the year, and most people weren't calling for that. We did get that right, so I think the market is expecting 2 cuts, and I think with a Trump Fed, not a Trump Fed, it's the wrong way of saying it, but a favorable Trump Fed, for instance, I think his influence and some of the dovish members on the board will be able to 4 cuts. And really that only brings the rate down to 2.5 to 2.75. I think 3. I would really bet and bank on 3 cuts this year. But I do think Trump will push for a 4th or whatever, and trying to go the extra mile or whatever.
For sure. And are we looking at these as all good cuts, some bad cuts? How are we looking
I
at these? Good
think
or bad?
it's good as long as the labour market doesn't fall off a cliff. It's all good. If the labour market shows a gradual sign of weakening, continued weakening, and the Fed can cut into that and get rates closer to neutral, it's probably not far off neutral now. Maybe 1 or 2 cuts, and then it's at neutral.
Okay, absolutely makes sense. How does this play into Bitcoin? I know we've got some charts pulled up as well. I'll actually share my screen, but what are we expecting from Bitcoin over the next couple of days based off of this? And I'll look to pull the charts up too as you speak.
So chart stuff aside, metric stuff aside, I would think if the data comes in tomorrow as we expect, as the forecasts are, I think Bitcoin can bounce off this 89, 90K. Again, similar for what we called today in today's update and in the last few days. Retest that 90K area, which is done, 89, 90K. It's found some buyers in there, and I think then we can bounce from here. But tomorrow's got to play ball, if that makes sense. So I think that's where we're at from the economic data driving price perspective. This other perspective that we're looking at now, and this stuff is stuff that we've been looking at for the last few weeks and months that has helped us get risk on at the right moments and get risk off also. And this is really important. Getting risk off at the right moments is also really important. Selling Bitcoin at 110 and getting back in the mid 80s or whatever, and you save a 30% drawdown. If you have $100 and you take a 30% drawdown, you now only have $70. You need a 50%, give or take, 50% increase to make up that 30% downfall. So risking off at the right time is also pretty key. These are metrics that we've been paying most attention to because we think these are the biggest drivers, liquidity aside, etc., for markets. Again, you look at that from the macro perspective, but looking at it from this perspective of mechanics, on-chain and technicals, which is what we've been looking at short term, because we think liquidity has been a bit sort of flatlining or toppy, whatever. This is what we've been paying attention to. So should we start on slide 1, the framework?
Yeah, absolutely. So we'll go to the top and we'll talk through this. And yeah, I guess I'll start. Basically, we do a lot of this when it comes to our market updates. So typically, the market updates are focused on 4 things, I guess. Macro being the overarching thing. That includes mechanics, on-chain and technicals, and this is what Tom does every single week. I guess we can go one by one. Tom, let's look at market mechanics. What do you mean by this? Why does it matter? And then we can look at the actual charts.
So these are like the main bits that I've been looking at recently. Open interest and funding rates. Again, that's just working out like what the positioning is underneath, just looking at levels of froth, is it bullish froth? Is it too bearish positioning? At the moment, the funding rates are pretty flat, so that's good. If the funding rate is really positive, that would suggest that there's like excessive bullishness, is vulnerable to be flushed out, etc. And when you have very high funding rates and very high open interest, you're likely to see a flush out at some point, and it's usually a flush out of longs. The other side is also true, very high open interest and low funding rates. It's basically saying there's shorts are paying a big premium to longs to be short. So there's usually one-sided positioning. In shorts, for instance, if it's a negative funding rate, you can get whipsaws background. Ultimately, that's all been reset following October 10th. You have open interest, which is much lower, although it has picked up recently, and funding rates are sort of flat. They went negative for a little bit, but they've mostly been flat. This is good for positioning. This is why we thought, a week ago, whenever it was, that we could get a little move up. It's one of the reasons we could get a little move up, because the actual leverage setup behind the scenes is good, it's healthy. We then looked at something called the Coinbase premium. Simply put, Coinbase premium is, if there's a premium on Coinbase, it means US buyers, there's an aggressive demand from US buyers on Coinbase. And that's usually larger capital that can push prices higher. So the chart you've got there, we look at the chart like that, and we were looking at how deep the premium was negative. So it was very negative, which is fine. It can still be negative and price go higher, as long as it's closing that gap from being extremely negative to less negative. And that's the move we've seen in the last sort of week to 5 days. And when we saw that really negative premium and we saw open interest reset, funding rates were flat, then you think it's a healthy setup. We could close that gap on the Coinbase premium, and that could help push price higher. And that's all what happened. And we've got that pretty spot on. So those market mechanics perspective, we have it covered. We've got the right stuff. What's now going to be interesting, I think, on this Coinbase premium is, do we have another dip back down and go negative again as price comes into this 89, 90, 91K area?
Okay,
That's something.
Development. Yeah, I have a quick question, Tom. If you had to simplify the relationship between open interest, funding rates, and price, and let's say open interest up, funding rate up, open interest down, funding rate down, and the inversions, is there a simpler formula people can kind of follow?
No. High open interest with funding rates high is usually the longs, so they likely to get flushed out. Open interest with high open interest with low funding rates, with too low funding rates, like very negative funding rates, means there's like basically too many shorts, and shorts are vulnerable to be flushed out. But it has to match with high open interest. We've had recently is flat funding rates and sort of relatively calm. Open interest has ticked up, but it's not been to too high levels. So you've got a sort of healthy positioning or healthy setup from both sides. We've then paired that with the Coinbase premium, which was very negative, and we thought that gap could close and become less negative, and that sort of gives us a bullish setup. So that's what we were looking at, and that's what I think we've called pretty spot on this last 7 to 10 days.
Yeah, absolutely. No, that's great. And what do you see for the next 7 to 10 days in regards to
We need to see
mechanics?
how that. So open interest has picked up quite a lot, but funding rates are still fine. So, but that you can get whipsawed on individual days, for instance. But the Coinbase premium, like yesterday and today, has started turning lower again. So you want to watch that to see how that develops into this 89 to 91k region. So I wouldn't really take too strong of an opinion on it today. Again, this is short time frame stuff, really. Talking like 1 to 7 days kind of stuff. So I think it's best to see how it plays out. But if it was to turn, increasingly negative, that would probably be a negative thing for price.
Okay, sounds good, man. I think that covers mechanics really well. Should we move on to some on-chain?
Let's go. So
Let's do it.
this is now the second part. We pair the mechanics with everything else that we're looking at to help us formulate overall picture, and then we apply a rough weighting to each of these metrics and each of these cohorts, mechanics, on-chain, technicals, to then gauge or estimate what price is going to do over that potential time frame. So in terms of ETF flows, they've been mixed now, to be honest. They were looking better, but yesterday, Tuesday and Wednesday, they weren't very good. So again, this chart wasn't updated today, but you had this most recent day was Tuesday, which was a big outflow, not huge, but a biggish outflow. But Wednesday's data was another big outflow. So, but you've had big inflows as well there. So again, it's we've seen some sizable inflows, outflows, but ultimately sort of net flat. So it's not something that's that big a driver for price on a week-to-week basis at this moment in time. But it can be on a day-to-day basis, which is why it's sort of important. It's a lagging, you get the data a day later. So it's, you can't really act on it in the moment, for instance. But yeah, that's what we're looking at. Again, we saw the reason we turned bullish 10 days ago. Again, this aided towards that was that we had low net outflows, then we start to see a couple of the inflow days, and then you start thinking, okay, cool, maybe this is starting to turn a corner. You've had the tax loss harvest selling in December, maybe there's going to be repositioning in early January that could help push things up, especially when you've got a healthy mechanic set up in the form of low open interest or relatively calmed open interest and low funding rates, whilst the Coinbase premium is very negative, and you can have that gap close. What we also saw on the on-chain part was the long-term holder selling net position change was decreasing. Yeah, there you go. So you can see in that red, you can see long-term holders are still selling down their size. But again, it's a closing of the amount of selling that's being done. So like closer back to, look at the black horizontal line, look at that as your neutral line. You have deep selling, and it's becoming less and less and less selling as the red creeps back up towards that neutral line. So again, you're sort of past the, you're sort of past the max sell pressure. It can always re-increase again, but sort of the seller exhaustion, it looks like there's seller exhaustion there. So that was another metric we were looking at. Then looking at key cost basis levels.
Yeah, explain this to people in a little more detail, Tom. There's a lot of people.
This is important against technicals. So this is one of those on-chain metrics that you can pull out and try to match it against the technicals on the chart and where the current price is against those technicals on the chart. So the best way I could describe it is to say, okay, forget what's happening in the price chart, forget that for now. Let's go and look at the key cost basis levels. Have short-term holder cost basis at 98k or whatever it is, 98.8, 98.9, and then the 200-day moving average is 106,500, so 106,000. So essentially, there's a lot of key. So there's less important cost basis in terms of like you can look at cohort ages and things like that. There's a lot that stack up between this like 98k level and 106k level. So okay, those holders are now currently underwater whilst Bitcoin price is below those key cost bases. So if that's the case, if price goes up, going to be people then in loss, and then they're going to go back to break even. They're going to say, that was too painful for me. I'm out. Thanks very much. So those are the key cost basis levels, act as resistances. If you then pair that with the actual chart, Bitcoin was at 86, 87, 88. And you say, okay, to the upside, there's a horizontal resistance at 95. we looked at the chart before, and there was big moves up into 93, 94, sold into 93, 94, 95, sold into. So again, if you pair the on-chain resistances or possible resistances, which are people's break-even prices, having been in loss right now, they're quite similar to the technical resistances on the chart. So I think the actual chart, Adam, is the last slide 18. So you can see that it's at 95, 400 or whatever it is. And technically, if you look at it from the technical perspective, we're still in a bear flag. I know it's a bit disgusting to think of that still is in play, but that is actually, unfortunately, still the setup at this moment in time. And then you view it from that perspective of, okay, we have the mechanics where it is, we can have that move up, which is exactly what we got the breakout, the downtrend line, which we called for, gets you that move up. But then you're asking yourself, can we get above these resistances, which is those key cost basis levels, the technical levels of 95,000, etc. That's why when we saw the breakout for Bitcoin, we thought Sol was a better play at 124, 125, 126. For a move up to that resistance level at 144, and you got that playing out perfectly. Bitcoin got into 94, 95 and rejected for now again, but it has come back down, found support at 90, 91. But the reason we're looking at those levels is we want to play the meat of the move. It gets those supports or resistance levels. You don't have to continue betting on that position. You can just come out and say, I'll see how this now plays out. I've taken the meat of the move. Sweet, thanks very much. I'll now reassess in days to come. But that's what we were looking at for key cost basis levels, is you're trying to identify it in the on-chain. What are the possible resistance levels for price if it was to go higher? Where are we going to meet resistance from? So it can be anyone. It can be wallet cohorts, wallet ages. The simple ones are short-term holders, long-term holders, 200-day moving average, etc., which is why we looked at those. And then there's still more of the on-chain. So then you have net institutional buying. This is a good chart from Caproll. So if we go to chart or slide rather, I think it's 415, shows like net institutional buying, which is essentially trying to track. So the bit at the top is a bit more tricky, but look at the bit at the bottom and look at the green or the red. Green, you're essentially looking at to work out is net buying positive of Bitcoin by institutions, etc., or is if it's red, it's negative. So you try to get these metrics and simplify them as best as possible. I don't know if I'm breaking up here. I seem to be slow, but I'll keep going. And we've seen a move, and these are the big moves you want to see. I think is a move from deep red. So again, if you start to see the green and then it dips into below the neutral line and red, when you start seeing that peak and bottom, it's even though you're seeing institutional selling still, it's slowing. So again, what we're seeing with the long-term holders potentially is that selling is slowing. So you're past the peak level, and that's what drives price to the really low levels. So again, this chart is now gone from being deeply red to now very slightly green. Again, we're gonna have to keep tracking this because it's at that neutral level. And we see back in late summer 2024, it was choppy for a little bit. It went green, came back down to red, and then it really peaked back up again. So you got to constantly be monitoring this stuff. Again, another good chart and another reason why we went bullish, 7 to 10 days ago. Wait for the cough. So that then covers on-chain. So we've had the mechanics, which is open interest funding rates, and then Coinbase premium. You've then had on-chain, which is key cost basis levels, long-term holders selling, ETF flows, net institutional buying. So you're putting all these different metrics and indicators into buckets, cohort buckets, whatever you want to call it. And then the last one we have is technicals. Again, we sort of already briefly covered this. but it's it's looking at key levels on the chart in terms of like just technical patterns. And technical pattern does not help you that much, but it can help you in terms of just if all the rest of it is bearish or bullish, you can look at the technicals to work out potential resistance support levels for the move. For instance, if you think a breakout is going to happen, you'll look at the technicals to work out where do these resistance levels come in and does that align with on-chain mechanics, etc. So we sort of covered that, which is still in a bear flag, but a breakout of the downtrend line and a move into the horizontal resistance at 95k, which is sort of just below some of the key on-chain resistance areas. So it just helps you build a picture. You get the breakout at 86, whatever it was, and we chose Sol because Sol the chart looked better for Sol than for Bitcoin. A Bitcoin move up of 10% is going to give you a Sol move of 12%, 13%, and that's what we got. So use everything to work out what Bitcoin's going to do. That can help you with the rest, and that's why we picked Sol. And overall, some of the work that's gone into why we sort of picked that trade essentially. But this is all aside from working out the macro to work out if monetary policy, fiscal policy, etc. rates are supportive of upside, downside, whatever it is. So it's mixing all that together, applying weighting to it to then work out we're going up or down basically.
Very cool. So we looked at mechanics, we went on-chain, we looked at technicals. When we talk about macro, do we mean on-chain and mechanics, etc., or is macro fully just looking at what's happening with interest rates, what's happening with inflation, and what's happening with the job market?
I would say it's different. I would say mechanics, on-chain, and technical. Technical definitely is charting, but I would say on-chain and mechanics isn't macro. No. Macro is more just what's going on. Geopolitical stuff is macro as well, which that's something not even covered. But you might just go risk off if a situation kicks off in Iran a little bit more. And I think it's possible that we can have Khamenei flee essentially. And I wouldn't be surprised to see that this week. I know we've gone off a bit of a tangent here, but I wouldn't be surprised to see that this weekend. And this is just a bit of education, if I can do that. Trump will do something on a weekend, Friday night, Saturday, Sunday, because the stock market is closed and it doesn't affect the stock market. Crypto is open. So if you're going to get something bad happen, it's going to be on the weekend and people will risk off where they can, which is crypto because it's still open, it's still liquid. So that's just something to be aware of Friday nights, Saturday evenings. Yeah, Khamenei, that's what I said, no?
No, you said. That makes sense, Tom.
Something to watch out for.
Yeah, no, absolutely. When you're looking at the stock market, gold, what's happening with oil right now, do you consider that macro, or is that like an ancillary thing? How do you picture that?
I would definitely bucket that into macro. The oil situation is interesting at the moment. Venezuela, obviously. I would say I'm not an oil expert, but I've been reading a lot more on the oil situation just to see how much it's going to affect the disinflationary narrative. Essentially, keep it short, Venezuela has really terrible oil infrastructure and they have very heavy, thick oil, which it needs to be moved into the US refineries to then actually be made into petroleum or whatever it's going to be used for. He is lowering the sanctions. So Trump is now saying he's lowering the sanctions on Venezuela, obviously because he half has control over the country, etc. So it'll be interesting to see how it develops, but I don't think it's anything meaningful at this moment in time. I don't think it means oil price up. Maybe the very, very short term because you have interruptions to exports. I think that should still plug along, flow along as normal. But long term, I think Trump will try to push oil down to $50. But put it in perspective this way: Venezuela exports about 900,000 barrels of oil a day. Call it 1 million barrels a day. Total world consumption is 110 million a day. So you're sort of less than 1%. So how much that changes that 900k? Is it 500k? 2 mil? It doesn't make a huge. It's not really going to move the needle. Iran situation with oil is very, very different. Something blowing up in Iran, for instance, or there being major disruptions there, OPEC, the Saudis, etc., can plug the hole, but it can, if they was to close the Strait of Hormuz, for instance, back months and months and months ago, that would have been a huge disruption. Oil price would have skyrocketed. That's bad for inflation. Trump rates bad. But the Venezuela situation is very different, and it's nowhere near as bad or risky for markets, which is why they just. I think Trump sent the Delta unit or whatever they're called on the Friday night, and the stock market just opened up higher on the Monday. It was like, yeah, cool, like, this is all completely fine. So it's a bit of a nothing burger event, but it's bearish for oil longer term, but only slightly, not much.
Yeah, not much. Obviously, there's increased supply, but like you said, if it's less than 1%, it won't make that much of a difference outside of, I guess, headlines, right? You touched on Iran for a second. You mentioned Khomeini, and I keep seeing memes of Khomeini and Assad playing Xbox in Russia. So what's going on in Iran right now, if you had to summarize it, and why does it matter so much?
I don't think it matters that much unless like Khomeini, however you say it, folks like refuses to leave. They're saying he's not going to refuse to leave, and he's like got a sort of flee plan to get out and get to Russia. But it only really kicks off markets wise if he sort of kicks off a war. That's the only time it would really sort of cause a problem. But I don't think that is unlikely. I think Trump just keeps applying the pressure, and because there's huge protests. I think it's something I saw today. It's now, I think there's 32 regions in Iran, and 21 of them are protesting. I read that today, so that don't quote me on that, but it was a significant portion of the country is like protesting in a big fashion against Khomeini. So I do think it's a bit of I think he's going to get pushed out, to be honest. But I don't think it's going to be huge for markets. You need to watch it, because if he kicks off somehow by bombs and sending missiles over to Israel, just whatever, that could be a problem. But if he flees and leaves, it's bullish.
Okay, that makes sense. Do you look at the housing market when you're looking at macro? I saw something a couple of days ago where Trump talked about stopping institutions from buying single family homes. And I think it was the Blackstone index dropped like 10%. Are you keeping an eye on the housing market?
Yes, stuff like that, more loosely, not as vigorously, or not as like strongly, but loosely, yes. And it's housing in America at the moment is in like a recession. Like the sector housing is in a recession, because you're just not seeing the turnover. People are not choosing to give up a 2, 3, 4% mortgage that they got in 2020, 2021, etc., or move house and to go into a new mortgage that's at 5, 6, 7%. So it's just there's not the movement of the inventory like there was 5, 6 years ago. So I think that's why Trump is pushing so much for lower rates, to get the housing market moving again. But again, what's positive? That's then positive for housing, because people get to realize more equity by bringing the rates down. More people's mortgage payments come down. They have more disposable income. They spend more. Blah blah blah. So all of that stuff is good, but ultimately it's our rates coming down, and that's good for asset prices, regardless of the housing stuff.
Yeah, absolutely. You know what, Tom? As I listen to you talk about on-chain mechanics, technicals, and even macro, it seems everything is setting up to get very, very bullish. And we published our 2026 Outlook report a couple of days ago, and we even included the catalyst calendar near the end. I'll pull that up actually while I let you go and talk for a bit. But are we in agreement? Is 2026 shaping up to be very, very bullish? Number one. And number two, when does it begin? Is it going to happen in the next month, the next quarter? Is it mid-2026? It just seems everything is priming for a really big run. But when do you think that starts to happen? Could we be there? One of the big questions we've had as of late is relief rally or sustained rally? But yeah, do you think very, very 2026, and when do you think it starts?
I think if you're going to have a rally, like a real meaningful go past all-time highs, etc., it's going to be 2026 rather than 2027, because you still got rates to come lower. A Trump Fed is very supportive for asset markets. I think at this moment in time, if the Fed stays on hold for 1 or 2 more months, markets can still be like more range bound or subdued for 1 or 2 more months. But I think it's once Trump announces a Fed chair, Powell becomes a shadow chair, and then people start listening to the new Fed chair. And if he's bullish, i.e. dovish, which he will be because Trump has picked him, or her, maybe he picks a woman, I don't know. No woman is in the running at this moment in time, but you know what I'm saying. Anyway, it looks like the people in the running are all men, but yes. If he picks someone, they'll be dovish, like 90% chance they'll be dovish. And then I think the market will then start pricing in more rate cuts from that point onwards, and you'll start to see asset markets really start to move higher then, without the rate cuts even coming yet, because it'll be the pricing in of the future cuts that are going to come. So Powell is replaced mid-May. When does Trump announce a successor? January, February latest. So, then the successor will start speaking a bit more, doing more interviews, etc. Maybe it's February time, something like that. That's what I'd be looking at. But I think once that happens, we can have maybe not a good year from there, but maybe a good period at least.
That makes sense. A couple of weeks ago, we were talking about potentially revisiting lows. Now, obviously, we have to adapt, and as new data comes out, we always pivot. That's the approach. Are new lows still on the table? Could something happen that sends us there? Or do you think we chop and eventually move up?
I think new lows are still possible. I know people are going to kill me for that, but I think it's much less likely than it was a month ago. But the market is in this sieving out process. It's you have it's a weird dynamic, because you have the end of the 4-year cycle, and the 4-year cycle believers selling their coins, causing huge long-term holder supply to come back to the market in Q3, Q4, 2025. So it's like, is that overhang enough of a push down on price that everyone else is bearish and prices just continue to go lower? Or is it that you get this resetting, price like grinds higher, which I think is probably the more likely, is even if you get a retest of like the low 80s, mid 80s again, I think that would be absolutely fine. And I think that would be, I find, like, quite normal to even go and do, probably healthy to actually go and do. And especially if you think what the setup is, February, March, April onwards, with a new Fed chair, etc., you should be wanting 80, maybe even lower. You should be wanting that, because you get a better return on that level on the move up again. I think this year, I think 2023 was easy, 2024 was easy, because you had you knew you were going to go and get 50 to 125 of cuts rate cuts both years. I think you got 175. Sorry, 2024 and 2025 rather than 2023, 2024. 2023 was easy because rates had peaked. So then the next move is going to be lower, and it's very restrictive. So the rate has to come down substantially. That's supportive for risk assets. At this moment in time, you're going to still get more rate cuts. Most likely, it's very, very likely you're going to get rate cuts rather than a hike. That's very, and Powell was even asked about rate hikes. I think it was the last meeting, not the meeting before, but I'm not 100% sure. I think it was the last meeting. And rather than him, usually what he does is he'll sit there and go, "Oh, we're not on any pre-committed path, blah 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 blah." But at that time, he was like, "No, that's not in our thinking." He said, like, sort of completely ruled it out. But obviously, that's a big positive. So you've then got to say to yourself, 2026, you're likely to see more cuts, probably at least 2. I'm betting that it'll probably be 3, probably 4. So that should be like good and stimulative for risk assets, particularly if the AI trades hold up, which I think they will, because the earnings growth is still very good. So yeah, I think it's a decent setup.
That's really good. No, that's very, very good. That's really cool. I think what I'll do, Tom, before we open up the floor for questions, is I'll share my screen one more time, and I want to go over the catalyst document that we had. I'll pull it up now. Let me see the 2026 outlook. Where would I see it? What's going on? Yeah, we had a calendar. It's being a bit tricky. Okay, I'm gonna risk it. Entire screen. Let's go. No one text me anything insane. Okay, do you see my screen, Tom? Yeah. Could we talk through some of these things and maybe one by one? And you can top level like commentary.
Yeah. MSCI final decision. I think Abroad was looking into that more than me, perhaps. But it seems to me that we had a decision on that. I believe it seems to me that MicroStrategy hasn't been ruled out of the index, but I think it's something like future stock offerings won't be included in the passive flows. It was something like that. So it was a headline bullish thing, but underneath it wasn't that bullish either. So it's sort of mixed. And I think strategy is like at its lows at the moment. Oh no, it's had a big bounce today, 4.4% today. That's not bad at all. I think strategy is doing a bottoming process. I think it can take more months, but I think it's doing a bottoming process at this moment in time. But yeah, anyway, let's go to the next one. FOMC meeting, I think we covered that. And again with March, FOMC meeting, I think we covered that. I think the rate cut for January is not likely. I think for March, there's potential, but I think with the data that comes out, it'll move closer to a 50-50. I'm not sure it will happen. I think it will come maybe April or May. A token 2049 in Dubai. I've never been to a conference before. I don't think I plan on going to one.
So. Very interesting, Tom. Those conferences are very interesting. We saw recently, we saw on a breakpoint, a lot of great innovations, which is very, very cool. And I think when you see events like Token 2049, it really builds that community spirit and gives people almost like a new, like a revived, a rejuvenated energy. So I think those events are always really good. Last year was very interesting too. A lot of it's online recorded. I think the 20 millionth Bitcoin mined, I think that's more of a psychological thing. I think it's an exciting event. I think you'll get lots of press around it, but I don't think it makes that much of a difference. Tom, on the 17th and 18th FOMC meeting, and then the 28-29 meeting, are we going to get cuts in either of those?
Maybe April.
Okay. How do you think the market's going to react by then? Where do you think we're going to be at outside of macro, I guess?
I said the same as what I said before. I think even if the cut doesn't come until May, I think the new Fed chair will be announced January, February time. And then the market will start pricing in as he's speaking, she maybe, whatever, whoever it is, start speaking in a more dovish tone. You're then more likely going to get the market pricing in future cuts. At the moment, the market is sort of pricing for 2 cuts this year. So you get an increase to pricing in 3 or 4 cuts this year. That will be a nice uplift in markets. But that will get priced March, April, May, for instance, and the cuts will come May, July, October, something like that, So it's like the market will react before it because it's pricing in what's happening before it actually happens because the Fed does the forward guiding.
Yeah, that makes sense. Talk to me about the possible government shutdown again in Q1.
So I don't think this will happen this time. So I'm not like an expert on that whatsoever. But I'm at the moment using the prediction markets for that stuff to work out like, is this 50-50? Do I need to go and do a ton more reading on it or not? If it's sort of out of my like knowledge sector or whatever, then I wouldn't. I would go to Polymarket. If Polymarket has it at like 15% chance for government shutdown, I'd say okay, cool. Like, sort of my answer there. I still track it.
Same. I feel your pain. Polymarket says there's a 5% chance Jesus comes back. So I don't know if that's the platform for you, but it is what it is. Let's see.
Yeah, that's how I look at it usually.
Yeah. Okay. Cool. Very interesting, Tom. Tom, I think we covered it very thoroughly, and there was nothing else in the um, Catalyst calendar I think we have to touch on related to your skill set. In particular, we covered on-chain, we covered macro, we covered
Mhm.
mechanics, we covered technicals. I think we should open up the floor for a few questions. So if anyone here would like to throw over a couple of questions, that'd be great. I haven't been checking the chat throughout. So yeah, I think now is the time to throw the questions in. Let's see. I see Pro saying bullish. Tom, are you bullish for Q1? If you had to say yes or no.
Yes, but I think I think we could go. It depends if we move to 95 now and then break out. But if we do turn over and go lower, I think it's a buy for higher by end of Q1. And I think like you get like mid 80s, low 80s, for move into then 100 by end of Q1, or maybe even more by end of Q1. That's a really good setup, a really good trade. That's so I'd prefer the move down just because it's yeah, better gains, I suppose. But yeah, I would say bullish.
Okay, same. Me too. I'm super excited for Q1. I do think it's going to take maybe until Q2, Q3 before things get really interesting, but I'm excited for Q1. If Q1 or Q2 is bullish, can we get a new pick? You have a pick right now, guys, so I'd focus on that one. I think that's the play. What's Polymarket's predictor? Crazy questions we get here. Let's see. The questions, I think a lot of it's a market structure. I think that question's a bit better for a bro. That one, guys. Why did the institution decide to get into crypto? It's related to macro. I think Orangina, that's a very broad question. I think it's where they see opportunity. I think if an institution sees a way to capitalize and make money off something, why would they not? I think when you look at entities like BlackRock and these huge institutions, if they think there's a way for them to profit off of something, they will absolutely shoot their shot. And I think with a lot of these new ETFs you see talked about, Solana, XRP, Doge, etc., they're just looking for a way to repackage something and charge a bit of a premium. How low do I think Solana can go if the market goes bad? Tom, what do you see for Solana? Bearish case. You're muted, by the way.
Sorry, what was the question? How low
Yeah,
can Solana go?
yeah. How low could Solana go? In the case where you think we could see new lows for Bitcoin, how low do you think we could see assets like Solana and Ethereum?
Uh, say maybe 105 to 120. I don't think Sol would even go as low as that, to be honest. Like maybe retest 110 to 120 again. I just think that sort of 100 to 120 area for Sol has been a really strong support for a long period of time. So I think it's a buy again if it was to like retest that area. And again on this last 2 weeks, whatever it was, Sol was the one that I chose to play. Again, I feel quite comfortable in Sol rather than an ETH, for instance. A retest of 110 to 120 would be I'd say a pretty good buy. ETH, I think ETH is a bit more. There's downside. I think ETH, for instance, if the whole market goes lower, I think ETH would be more cooked than Sol. I think ETH would go down to like probably the block at 2.4, 2.3 to 2.4. It might find support at 2.5, 2.6 again, but maybe I'd step in again on a break below 2.4, so 2.2, 2.3, 2.4. But I'd still I prefer Sol because I think I don't know. I feel more comfortable. I'd sleep better holding Sol than ETH, which I know sounds mental, but I don't know. I would just feel like on the good days, Sol will outperform for me, and it will get me into the green on my trade, on my P&L, for instance. So I'd rather pick that as my play than not. But those would be like the levels I would like look at.
Okay, very interesting. Another good question is, when we're referring to long-term holders, what constitutes a long-term holder?
For the on-chain, okay, so it's 155 days is what. So there was a metric going around on Twitter that I saw, which was that a lot of long-term the coins, the long-term holders were holding essentially a movement of coins from short-term holders to long-term holders, and it was like changing the metric from being in a loss to being profitable, or accumulating to distributing. Sorry, that was it, accumulating to distributing. And I saw everyone on Twitter saying this is bullish, long-term holders are no longer selling, they're accumulating, and it wasn't the case. It was just a transition of coins from short-term holders crossing that 155-day threshold and to becoming long-term holders. So it's done on the I forgot what it's called. So it's when the coin was last moved, and if it hasn't moved in 155 days, it's classed as a short-term holder to then become a long-term holder.
Yeah, that makes sense for sure. A question here is about the reports mentioning choppy bearish Q1 and Q2, but then we're talking about being bullish now. I think it's important to note there's a big difference between bullish, meaning, hey, we might hit 105, 110, versus we're hitting all-time highs across the market. As a consensus, Q1 and Q2 for Cryptonary, it's choppy. Not necessarily bearish. It could happen. Tom mentioned we could see new lows, but more choppy for the first 2 quarters. But where we expect to start to see all-time highs for a lot of assets is Q3, Q4, for multiple reasons. There's a few other questions here. Is CPro going to start to cover trades and picks within stocks? Yes. So I think if there's one thing we as Cryptonary missed throughout 2025, it was seeing opportunities outside of crypto. There were loads, but we didn't see it. And I think it's a lesson to all of us. People often get caught in echo chambers, and we're here, we're looking at all these different altcoins and Bitcoin, etc. And we're seeing gold and silver hit all-time highs, and the S&P hitting all-time highs. And we're not going to make that mistake again. Throughout 2025, there were lots of initiatives to make it possible to trade and even supply liquidity, to concentrate liquidity pools to stocks and some of these other assets. You can get exposure to gold, to silver, to the SPX through on-chain. So going into 2026, we absolutely intend to cover it. And that'll be really exciting. I think Tom will do a great job. Yeah, the S&P. So yeah, the stocks available now, so we have to cover them without doubt. That'll be very exciting. Maybe we launch a new series specifically focused on these things, or maybe the way Tom currently does, where in his market updates, he touches on gold, silver, etc. We go into more detail. So we actually, I think we absolutely will, 100%. Yeah. So we'll see that. Okay, cool. Any other key questions, guys? Okay. So I appreciate it, guys. Thank you very much, Tom. I appreciate it. Great chat. This was good. And yeah, guys, I appreciate the time. See you in some of the group chats. Take it easy.